This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. And welcome once again to the Wealth Roundup. I'm Terry Evans along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Here we are for the week of February 20th, 2026. Patrick, how have the markets been looking since we spoke last?
I would summarize that in general, the markets are a little weaker since we last spoke. So pretty much across all of the assets that we tend to take a look at in the podcast, maybe weaker in a way that it's not overly noticeable. And I think that sometimes, investors, it's a rude awakening that the markets just don't always go up and up and up. If we take a look at the U.S. market, the S&P 500 down today, down almost 2% since last week. So that's a pretty significant decline. The TSX also down, but not nearly as much, down about 1% since last week. Gold well off its highs, but still a strong 7.5% return year to date, just below 5,000. I think it's in around $4,800 US. Bitcoin still continues to be weak, well below 70,000, but there's been a lot of weakness in Bitcoin. So Bitcoin is actually up about 1% since the last time we had this call. Maybe one of the few positives is that the discount rate on Western Canadian Select versus WTI, not quite as much of a spread as we had seen. So, of course, Iran back in the news again. That always tends to push up global prices of oil. And Western Canadian Select has got that discount at around $12. So not as high as the 14 that we get overly concerned about, but also not nearly as attractive as the $11 spread, which is a little bit more favorable. So I think that, if we were to say why, what would be some of the drivers in behind that? I would say a couple things is that I think there's still some concerns about AI disruption and what that's going to, who are going to be the victims of that AI disruption. Because, we expect there to be some collateral damage. We've kind of talked about missed earnings. We've talked about all the spending, talked about how these companies are going to, monetize to recoup their AI spending. But what that's led to, which we've talked about a couple times, just this broadening of the markets. So other players and perhaps maybe even the markets looking beyond the US. So Canada, Europe, emerging markets. I think, the markets are looking at investors' conviction is being tested. And so investors are looking for where they can find continued strong earnings and perhaps a better price. Earnings season, we continue to move through earnings season. We get Canadian Tire out this week, so that's always a really good kind of bellwether here in Canada about the health of the consumer. And we believe that the consumer had shown a little bit of weakness in spending, through the Christmas season. Now, whether or not the severe weather that we've seen across Canada perhaps helps, you always want to have another snow shovel in the garage, or you chew through the power cord on your snowblower, and you're either deciding to go get a whole new snowblower or maybe just fix the power cord. So that that would be something. And then two other really kind of interesting Canadian businesses that had earnings come out recently. So Cameco, uranium producer here in Canada, they along with Brookfield own about 49% of Westinghouse, which is a global corporation that runs and manufactures nuclear power plants. And so we know that nuclear is going to be the one of the long-term solutions to the increased energy demand globally. So, good results there, which is good. And then Magna, which is in the auto parts business. So definitely in the eye of the storm of the new tariff policies, and specifically what's going to happen with the auto industry here in Canada, is that Magna's done a lot of things that are more within their control to help boost their earnings. And largely that is watching their costs. So they're being very careful about how much money they're spending on their business. Under the lower stock prices from last year is that the company initiated a stock buyback plan. That's one way to kind of reward investors that continue to hold the stock, is that, if once you buy back stock, there's a smaller stock float. that's also good. And then what we think is that as long as in North America, the overall auto manufacturing remains consistent, Magna will still be relative, and with kind of some of these self-help ideas that Magna is doing, should lead to still strong earnings in the future. And so they came out with good earnings last week. We still expect good growth with regards to Magna, and that stock buyback program certainly helps. So kind of a mixed news in the markets, but we're also getting to see, we talked in the last podcast, we were 1 year of tariffs. So what are we seeing? Well, here's a company, Magna, very important to the Canadian auto industry, albeit on the part side, and they're finding a way to succeed, which is a positive.
This time of the year, you talk about how results are coming out for companies. It's also, we're well into the bill season post-Christmas.
Yeah, yeah.
The other thing that's happening is we look ahead to tax season. It's time to look at our priorities and choices that we have at this time of the year as we approach tax season.
Yeah, so we're about 2 weeks to the end of what we would call the RRSP deadline. So we get 60 days into the new year to be able to still make an RRSP contribution for the previous year. So March 2nd is the deadline. So here we're taping on March 17th. So to this point,
February 17th. Yeah.
Sorry, February 17th. Sorry, thank you. So Canadians are taking a look and saying, having to make choices, and maybe still looking at the bills from Christmas and looking at the MasterCard, preparing to do taxes. We should start to see T-slips coming in the mail here. I think February 23rd is when they should start hitting the mail. So that'll be a good, reminder to start kind of prepping for tax season. And then depending on how you do your RSP contribution, I think more people do their RSP contributions throughout the year, so regular contributions. But if you're looking to do that kind of last top up, you've often got to make these, you got to prioritize between contributing to perhaps an RSP. We've got new TFSA rooms, so $7,000 for the TFSA room, or paying down debt. And so I think that it largely becomes a battle between the math logic and debt and a person's debt aversion. So there's a couple of things I think that factor into this is that if we look at the math, the formula with math is that certainly for people that are in a higher tax bracket and they know that they're going to be in a lower tax bracket, that would be a factor that would perhaps help the math to suggest, making an RSP contribution might outweigh going and paying down some debt, depending on if you're self-employed or if you're working for somebody, and maybe if you're working somebody, they have some type of an RSP matching plan. So if you put in your minimum RSP contribution to your work plan, is your employer would perhaps match it. I think that also is something that factors into, yes, making that contribution is perhaps more valuable than paying down the debt. But also for the debt side is looking at the nature of that debt, credit card debt. If you're going to go beyond that, first 30 days where your purchases are interest free, any kind of an interest rate on debt that's over 10%, the math and the psychology are both suggesting you should pay down that debt. Also being very careful of some of this other type of consumer debt out there. You see lots of these, commercials, 0% interest payments for the first year, or some type of a kind of a structured or delayed kind of a balloon interest rate payment where you get some very attractive interest rates for perhaps a period of time and then they go up. So really keeping a close eye on those, because those interest rates become incredibly painful later on. And then we've kind of talked about, again, this is the importance of having that financial plan, that retirement plan. What was the playbook for the success of that plan based on both contributions, saving for retirement, and all those years, because we know that it's more about, how long you've been able to save and invest for as compared to how much you've saved and invested for, meaning somebody who starts early generally doesn't have to save and invest as much as somebody who doesn't start to save and invest till later in life. And so going back to that plan and saying, oh yeah, our plan was that we were going to add $10,000 to our RSP this year. So that was very important, as is debt elimination. The idea was that we weren't going to have our mortgage for 35 years. The goal was to, pay off that mortgage in 20 years or 15 years. And so that meant going and putting down a certain amount per year. So that's kind of weighing the psychology of going and holding debt and all of the stress that it brings versus the math and saying, if our investments are, making 6 or 7 or 8% on average, but our debt is 10%, or perhaps it's low interest rate debt. Maybe it's on a mortgage with still a very low interest rate, or maybe a line of credit with a very low interest rate. Perhaps investing is better. In general, I would say if both your investment return and your debt have approximately the same rate, is that I generally advise my clients pay down the debt. There's a variability to those investment returns. In general, once we look at investments beyond, call it the risk-free rate of return, which is pretty low right now, probably 2.5 to 3.5%, is that in order to get those higher returns, is you're in the market, and so those returns aren't going to be every calendar year. So we tend to say, pay down the debt.
So is it all encompassing? So you look at RRSP, TFSA, and other options that you might have. I know, like, having a meeting with you or someone like you who has a giant calculator and all of the resources and insight. Do I take out a loan to invest or to top up RSPs? And it all comes back to weighing out your interest rates and return on investment. I think it's very, very interesting and very valuable, and it's something that a lot of people do need advice or at least some guidance.
Yeah, and I think if you look at just the tax in isolation, I think of the accountants that we work with. The accountant doesn't often know the whole picture. The accountant is maybe looking at your T4 from work and your T slips that come in from your investments, or if you're a business owner, they're working on the financials for your corporation, but they maybe don't know about everything else. An accountant generally doesn't know how much debt you have. An accountant might see your investment tax slips, but they're not going to know how far along that investment journey you are to retiring on schedule. Not every investment advisor approaches wealth management the same way. I think certainly today in modern wealth planning is that investment advisors do use wealth planning calculators more than they used to. If we were to take this industry back 20 years ago, is that, your typical stockbroker would never do a retirement analysis for you. They would assume that you would just do that work, on your own. Whereas now most shops are kind of run as this kind of family office that does that retirement planning, helps you work on your estate planning, helps you kind of advise you with kind of structuring your business and your personal to pay the least amount of taxes, even though they don't do your taxes for you, as they provide that guidance by going and looking at both. So yeah, it is, you should always be throughout the year doing this kind of self-evaluation to say, are we, how close are we to our budget? How close are we to our savings and debt reduction plan? And that should, be a major component when thinking about, how we invest, when we invest. We would preferably like to always be investing throughout the course of the year, regardless of what's happening in the markets, so that we don't find ourselves kind of in January or February scratching our heads thinking, how much money do I have to, put into my RRSP, or do I have to borrow more money to add to my RRSP because if I don't, I'm going to have to pay a bunch of taxes. It's just that, I think that can add another layer of psychology and stress to going and managing money. So obviously, something we like to talk about in the podcast, because we want to kind of be ahead of the game.
Wealth management and investment insight. Go to patrickmleonard.com. That is likely where you found this podcast. If not, on YouTube, please like and subscribe and share, and reach out to Patrick. All his contact information is on his website to find out more about which direction you might go with your wealth management. And there you go. That wraps up the Wealth Roundup for the week of February 20th. I'm Terry Evans. Have a great week, Patrick.
You too, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.